This is Barry Knapp with Ironsides Macroeconomics. It's Monday morning, August 7th at 7:15 a.m. Mountain Time. Our note this week was titled The Real Bear Steepener. There were 5 sections to the note. The first one discussed the bear steepening we had in the Treasury curve. We had written about this a couple of weeks ago in an unstable equilibrium about different ways the curve could disinvert, and this was one of those, or last week's move was one of those ways, one of the more insidious ways we could get there, and one that often is associated with risk-off shocks, which we had a mini version of last week. We then went on to discuss the sovereign downgrade and titled that section In Defense of Fitch. As much hand-wringing as there was, Fitch made some good points, and so I'll come back to that in a few. We discussed capital for labor and what looks like a pretty good capital spending boom for S&P 500 companies, at least, if not the overall economy. Certainly that's true of the physical structures, manufacturing and tech, physical plant investment that's going on. We then discussed softer labor market demand as a wrap up to the labor market data we got last week. We'd written a preview that we released ahead of the employment report. And then, of course, we wanted to wrap up the employment report. And then a brief section on earnings season, which is effectively over. We do get a couple of more companies this week, and then we'll get the retailers in a couple of weeks' time. But for all intents and purposes, we've seen the bulk of corporate earnings this quarter. So first on the real bear steepening, we talked about 3 different ways that the yield curve might disinvert. A bull steepening, meaning rates going down, led by the front end rates going down, which of course would require the Fed cutting rates. Now that can happen for 2 reasons. One's a little bit more insidious or negative than the other. The first one being that growth and earnings fell sharply. Of course, inflation would probably fall in that situation as well, but that would not be such a pleasant environment. That by definition is a recession, a real NBER declared recession, that is, not just a GDI earnings recession as we've been asserting we've already had. The second would be the most benign scenario, which is disinflation and the Fed cutting rates because inflation normalized. The data last week supported that scenario, but the bond market went on its own way for different reasons. And then, of course, there's the bear steepening led by real rates moving higher. And when that happens in a high velocity sort of a way, often associated with Fed policy, that causes risk-off shocks. So you can think back to 94 when the Fed started hiking rates, 2004, and then the series of Fed policy-related corrections we had last cycle, mostly related to large-scale asset purchase programs, the end of QE1 in 2010, QE2 in 2011, the taper tantrum in 13, the 2 shocks we got in 2018, which were led by real rates moving sharply higher. And then, of course, the mother of all of them in 2022, which may have been just a policy normalization related correction or may have been related to the GDI earnings recession that we had. So there was both demand and supply factors at play. Demand has been weakening for treasuries as a consequence of the banks' problems with owning a lot of high quality treasury securities at the wrong price. We've also seen demand from our mercantilist trading partners that run big trade surpluses. There is no real rebound underway in trade, so they don't have the demand for treasuries to keep their currencies from appreciating that they did in prior decades. And then there's been some real changes in petrodollar recycling, which we discussed at length in the note. And then, of course, the catalyst for all this was the BOJ loosening yield curve control and getting people concerned that the country that owns the most U.S. fixed income assets across a broad range of different types of investors might wind up being a larger seller as well. They have been generally reducing their holdings of treasuries, though not so much this year. Over the last couple of years, that could be a big risk. But of course, the ultimate catalyst for this was an increase in supply. When the Treasury announced they were going to borrow, issue something like a little bit more than $1 trillion in the third quarter, expectations had been 733 billion. The last time they released those numbers a quarter ago, and then they announced they were going to raise 820 billion in the fourth quarter. Expectations had been something like 600 billion. So it's an extra $500 billion amongst friends. And that caused the back end to sell off. And that was really the shock that gave us a little bit more of a risk off type of atmosphere last week. The next section we described in defense of Fitch and the sovereign debt downgrade. We really didn't have any problems with anything Fitch said, other than we disagree with them that the debt ceiling and people like Jamie Dimon saying we should just do away with it. It's the only forcing mechanism we have in Washington right now. Otherwise, they just skip the whole appropriations spending process, jam all the discretionary spending for the year into an omnibus spending bill. It gets signed on Christmas Eve. No one knows what's in it, multiple thousands of pages, and it's just not the right way to run a railroad. So we do agree, however, with their broader issue with the CBO projections for the next 10 years that the government's going to spend 24 to 25% of GDP and run 6 to 7% budget deficits as far as the eyes can see. Fitch didn't say this, but we will. There's no way to plug that with additional revenues. We've talked about Hauser's Law before, how regardless of how we structure the income tax system, we're still getting 17.5%, 18% of GDP in taxes. There's no way to close that gap by raising taxes. That's nonsensical. Government spending has to be reduced. And of course, ultimately, to get the debt to be sustainable, we'll have to reduce entitlement spending. But the real issue for us is not so much a debt crisis. We really don't think that's probable in the investable time horizon, meaning the next 18 months or so, and maybe even longer, much longer than that. Our real issue is the inflationary implications of this. So we used it as an opportunity to go back and discuss the great inflation and what really caused it. We introduced this fiscal theory of the price level, and the professor that's been promoting this thesis going to be our next book that we go and read, his technical approach to the fiscal theory of the price level. And we would finally note that there's been a couple of shocks. The first ones in our 39 years in the industry, where big unexpected increases in supply. First, when the Democrats flipped the Georgia Senate seats on January 4th of 2021 through the passage of the American Recovery Plan, 1.9 trillion stimulus. Expectations went from expecting no additional stimulus to all of a sudden getting 1.9. We had a real backup in real rates at the back end of the market, the 30-year part of the curve that the Fed has the least amount of control over. And sure enough, that's leading the move again this go around because of this unexpected supply. So the U.S. does appear to be reaching its fiscal limit, and it's notable. Now, do we think this is enough to prompt new behavior or changes in attitude down in Washington? No, probably not. But we still don't think a debt crisis is the real risk here. We think it's inflation is the near-term problem. So moving on to our next section of the note, S&P 500 CapEx has been very strong. It's very robust across all sectors. Buybacks are going down. CapEx is going up. This is good news for productivity in the long run. Is it enough to offset this deleterious policy stuff we have going on, both from a monetary, fiscal, and regulatory? We'll see. For now, it looks okay. Inflation is still coming down, but obviously bears watching, and that's what we'll be doing. Labor demand is clearly softening. So headline payroll gains were 187 with a negative revision of the prior 2 months of negative 49,000. That's 138 net of revisions. The previous month was a 209,000 headline increase with a net revision of negative 100,000. Of course, there is the theory of revisions. When they start turning negative, that tells you where momentum is going. But that's 2 months in a row, pretty close to the 100,000 or so speed limit for job creation. Growth has slowed from 3.3 total employment growth in 2022 down to 2.2. Of course, those numbers are overstated by problems with the birth-death model that the Business Employment Dynamics report last week underlined. The work week is back down to its cycle low and last cycle's low. So again, that's a sign that demand for labor is weakening. Now, the price matters, and average hourly earnings have been stronger than expected the last 2 months. We still think that series is fraught with compositional problems because the ECI and Atlanta Fed wage tracker is coming down, and we do think wage growth is decelerating. We think the reason that it was strong was the great reallocation, which is an argument why we wouldn't worry too much about 4% wage growth, as Austan Goolsbee pointed out in an interview on Bloomberg TV, I think it was on Friday. If productivity is picking up, and the labor productivity numbers last week were strong. Now, they've been very distorted, so you have to take those with a little bit of a grain of salt. But we're absolutely convinced that when you get big labor market turnover, it's a near-term drag on productivity, but ultimately a positive for productivity, as opposed to wages going up because you're running out of bodies. That's a negative for productivity. So we do think this 4% wage growth with 2% productivity is fine, and that's what we think we have, is at least 2% productivity. That's where we were in 2018 and 19. So we think the labor market's coming down. Demand is weakening appropriately, and the Fed ought to be reasonably comfortable with that. So finally, on earnings, looks like they'll come in negative 2% or so. That's not quite a complete reversal to positive territory, but pretty close. And so the GDI earnings recession is ending. We think the recovery is being led by consumer discretionary. It's got the best surprise. It's got the best year-on-year growth rates. Margins are ticking back up. Revisions are still going higher. That's typically what you would see in a recovery. That is the leadingest of leading indicators. So does look like we're having a recovery, but we continue to worry about the financial sector. And the senior loan officer survey last week was nothing. There was nothing positive about it. Bad credit is still contracting, and we need the curve to disinvert, and we need it to disinvert in a fairly benign way. Obviously, the best way is that inflation continues to come down. That'll be the story at the end of this week, and that'll be obviously a big topic in our weekly next week. So, Barry Knapp, Ironsides Macro. Have a good week, everyone. Thank you.